Mathematics plays a central role in the development, implementation, and optimization of quantitative trading strategies. Quantitative trading, often referred to as quant trading, relies on mathematical models and statistical techniques to identify trading opportunities, manage risk, and execute trades. The impact of mathematics in quantitative trading spans several key areas, including model development, data analysis, risk management, and algorithmic execution. 1. Model development and strategy formulation. Mathematical models. Pricing models. Mathematical models are used to determine the theoretical value of financial instruments. For example, the Black-Scholes model for options pricing is a differential equation used to estimate the price of European options. Similarly, the capital asset pricing model is used to calculate expected returns based on the risk of an asset. Time series analysis. Time series models, such as autoregressive integrated moving average and generalized autoregressive conditional heteroskedasticity, are used to analyze and forecast the behavior of asset prices over time. These models help traders understand patterns, trends, and volatility in the market, which are critical for making informed trading decisions. Factor models. Factor models, such as the Fama-French three-factor model, are used to explain asset returns through factors like market risk, size, and value. These models help in constructing portfolios that capture specific risk premia and in developing long/short trading strategies. Statistical arbitrage. Mean reversion. Many quantitative strategies are based on the mathematical concept of mean reversion, which assumes that asset prices will revert to their historical mean over time. Statistical techniques like cointegration and regression analysis are used to identify pairs or groups of assets that tend to move together, allowing traders to exploit temporary deviations from their mean relationship. Momentum. Momentum strategies rely on the mathematical observation that assets that have performed well in the past tend to continue performing well in the near future. Statistical measures like Sharpe ratio, alpha, and beta are used to evaluate and optimize these strategies. 2. Data analysis and signal generation. Statistical inference. Hypothesis testing. Quantitative traders use hypothesis testing to validate the presence of trading signals in historical data. For instance, they might test whether a particular price pattern leads to profitable trades more often than not, using t-tests, p-values, and confidence intervals. Machine learning. Advanced mathematical techniques for machine learning, such as linear and logistic regression, decision trees, neural networks, and support vector machines, are used to analyze large datasets and extract patterns that might not be apparent through traditional analysis. These techniques help in generating predictive signals and optimizing trading strategies. Optimization techniques. Portfolio optimization. Mathematical optimization techniques, such as mean variance optimization, based on Markowitz's modern portfolio theory, are used to construct portfolios that maximize expected return for a given level of risk. These techniques involve solving complex optimization problems, often using linear programming or quadratic programming methods. Parameter tuning. In quantitative trading, the parameters of models and strategies must be optimized for performance. Techniques such as grid search, gradient descent, and genetic algorithms are used to find the optimal set of parameters that maximize profitability while minimizing risk. Dritter Risk Management. Mathematical risk measures. Value at risk. VAR is a statistical measure that estimates the maximum potential loss of a portfolio over a specified time period with a certain confidence level. It is used to assess and manage the risk of a trading strategy. The calculation of VAR involves complex mathematical models, including Monte Carlo simulations and variance-covariance methods. Expected shortfall, expected shortfall, also known as conditional value at risk, measures the average loss beyond the VAR threshold. It is a more robust risk measure than VAR and is used in risk management to understand the tail risks of a portfolio. Stochastic calculus. Option pricing and hedging. Stochastic calculus, particularly Ito's lemma and the Black-Scholes equation, is fundamental in pricing derivatives and constructing hedging strategies. Traders use these mathematical tools to model the random behavior of asset prices and to design strategies that hedge against adverse price movements. Risk-neutral valuation. This concept, rooted in stochastic calculus, is used to price derivatives by discounting the expected payoff under a risk-neutral measure. It is crucial for pricing complex financial instruments like exotic options and for understanding the behavior of derivative portfolios. 4. Algorithmic execution. Mathematical algorithms. Order execution algorithms. Mathematics is used to develop algorithms that determine the optimal way to execute trades, minimizing market impact and transaction costs. Algorithms like VWAP, volume-weighted average price, and TWAP, time-weighted average price, rely on statistical analysis and optimization techniques to break large orders into smaller trades executed over time. High-frequency trading, HFT strategies require advanced mathematical techniques to analyze market microstructure, predict short-term price movements, and execute trades in milliseconds. Signal processing, Fourier analysis, and queuing theory are some of the mathematical tools used in HFT. Optimization of execution. Slippage and market impact models. Traders use mathematical models to predict and minimize slippage, the difference between the expected and actual execution price, and market impact, the effect of a trade on the market price. These models often involve regression analysis and simulation techniques. 5. Backtesting and performance evaluation. Backtesting. Historical simulation. Mathematical techniques are used to simulate the performance of a trading strategy using historical data. Backtesting involves the application of statistical measures such as the Sharpe ratio, Sortino ratio, and maximum drawdown to evaluate the risk-adjusted performance of a strategy over time. Overfitting and robustness. Statistical methods are used to detect and prevent overfitting, where a model performs well on historical data but fails in live trading. Cross-validation and bootstrap methods are employed to ensure that the strategy generalizes well to unseen data. Performance metrics. Risk-adjusted returns. Metrics like the Sharpe ratio, information ratio, and trainer ratio are used to assess the performance of a trading strategy relative to its risk. These metrics involve complex mathematical calculations and are essential for comparing different strategies and making informed investment decisions. Conclusion. Mathematics is the backbone of quantitative trading strategies, providing the tools and frameworks needed to analyze data, develop models, manage risk, and execute trades efficiently. From basic statistical analysis to advanced machine learning techniques and stochastic calculus, mathematics enables traders to make data-driven decisions, optimize their strategies, and maintain a competitive edge in the financial markets. The integration of these mathematical techniques allows quantitative traders to systematically exploit market inefficiencies, manage risks effectively, and generate consistent returns.